I'm going to turn that on right now. If you're not comfortable with that, feel free to turn your cameras off and so on and so forth, or change your name, although it is not publicly distributed. We wanted to take the chance to introduce ourselves to you guys as well. A lot of you have had a lot of interaction with myself or with Giselle, Mike. If you want to turn your camera on for a second, Mike, and Giselle, give a wave. That this is our founding team. We are a Calgary-based startup. We've been around for just coming on 3 years. Rob is here as well, our CEO, and myself, I'm head of partnerships. Josh, who's not with us today, is head of marketing and client attraction. Giselle is our director of client engagement. So if anything is moving back and forth, usually Giselle is involved with it. And she's also the person who's most engaged with all of our sellers. And Mike is our head of product. So if you guys have any comments or questions or things that you want to see on the platform, Mike is always a great person to go to, and you might get emails from him from time to time. So we just wanted to all introduce us and show you who the team that is behind this engine that you guys are all using, who we are. I'm going to introduce Zafar, even though he's not quite here yet. Zafar is a partner with Gowlings here in Calgary. He has been practicing corporate M&A and capital market law, and practices in both public and private. He also manages Gowlings technology law space. And Zafar and I have known each other for a couple of years, and done presentations going back for the last 5 years together. And we also co-president the M&A Club here in Calgary. So he is a wealth of knowledge, and we're just going to throw him into the fire once he gets here. The last few bits of housekeeping today. So feel free to introduce yourself in the chat. It's nice to see a variety of people from across the country. I think as far east we are today is Toronto, and how far west we are is Vancouver. We'll be poking some people in Atlantic Canada to get them rallied too here. But introduce yourself. Let us know where you are in your journey, whether you're just starting out buying a business, or you're just new to the concept, or if you're knees deep, like a few of you are in this on a daily basis. We're going to go into the foundation of what's in a letter of intent and just lay the foundation. For discussion, if you want to raise your hand and then I can call on you, I'm going to shut the presentation down so I can see more of you, and then I'll see your hands raised. Or you can put questions in the chat for Giselle. She's going to be monitoring that. And if you don't want to pose your question yourself, you can send it directly to Giselle, and then she can ask it on your behalf. And then we're kind of changing the way we do our virtual events. We're going to really rally them up, and we're going to do 2 a month going forward. So roundtables will be for members and subscribers of Village Wealth only. In those environments, we get to know you a little bit better because everyone has had a coaching call. Everyone typically has a profile and their search criteria identified. And those roundtables are more intimate discussions, and we're going to start to do breakout rooms and have more engagement in those. Webinars, we're going to be doing 1 webinar a month and 1 roundtable a month. So that's how we get to 2. But the webinars are going to be more open topics. We'll invite more experts and guest speakers into the webinars, and less discussion, more presentation style or panel discussion. And just to let you guys know that the format is changing a little bit. So we always welcome your feedback if there's one that you would prefer. And we welcome your topics as well. If there's anything specific that you guys want us to cover, you want us to bring someone in to discuss, let us know. And then we'll put it in the queue. We're just setting our topics this month. So let us know. All right, I'm going to jump into foundations of a letter of intent. So your offer letter, called the letter of intent, is a short, non-binding contract that precedes the binding agreement, which is the definitive purchase agreement. It outlines the general terms of the transaction. This is what both parties are agreeing to in concept, and it acts as a guide for the definitive purchase agreement. So this is the document that your lawyer references when they do the real purchase agreement that is binding and final. So the letter of intent is, like, I often refer to it as, you hear people like tying deals in the restaurant on a napkin. This is your napkin. This is your napkin negotiations, but it's more detailed than that, obviously. And there are some provisions that are binding, such as non-disclosure, exclusivity, and the governing laws, but otherwise the rest of it's non-binding. Typically, you do see a deposit at this stage that holds it and moves you into exclusivity. So I'm gonna show you kind of the disclosure process. When you're first engaging with businesses that are selling, if they're represented by an advisor, you'll first receive a teaser, or when you see a listing on a marketplace, a site, that information is the original, the origin of the information that is released to purchasers, and then moving into NDA, which will release the CIM, confidential information memorandum, also referred to as a buyer presentation, or some people have referred to it as a prospectus. People, depending on who's representing the business, will call it something different. But essentially that releases more information about the company post NDA and gives you enough information to do your light evaluation. I saw Zafar come in here right now. Zafar, can you hear us?
Yes, I can.
Welcome. I already did your intro. Everyone already knows who you are.
Thanks. Sorry about that.
That's okay. I'm just doing a foundation here, and then we'll get into discussion and Q&A. So I'm just kind of laying the line here. Once you receive the CIM, again, light evaluation with all the information that you have. Again, they're not going to give you everything at this stage. You can ask for as much as they'll release, for you to do your early due diligence and figure out, how you're going to position this offer. And at this point, you're typically working with a lawyer, lightly maybe your accountant or another advisor to help you position your letter of intent. Then after that, you're putting your offer together, moving into your letter of intent, drafting your letter of intent, which once that happens, once you get that accepted letter of intent, it moves you into, here's my down arrow, the exclusivity and the due diligence period, where you get access to everything that you need. So kind of getting over this threshold is really what opens up, kimono to you to have exclusivity, make sure nobody else is bidding on this business for a period of time, and then gives you the chance to really dig in and do your formal due diligence, which moves you to the definitive purchase agreement that your lawyer would work on, and then conditions, removal, and closing. And then just on a high level, this is my last slide, and then we'll just get into Q&A. I just quoted this from a book called Be Your Own Boss, The Insider's Guide to Buying a Small Business or Franchise in Canada. I wanted to reference a Canadian source. And so essentially at a minimum, and we can send these slides out, but at a minimum, this is at a high level what should be in your offer letter: a description of what is being purchased and what is not, the basic structure of the deal, of whether it's share sale or asset sale, obviously both of your names, the date of the offer, the date of which the offer expires, the date of which conditions would likely be removed, the proposed closing date. And all of these, the sequence of dates sets the schedule for the next few months. The price that you're willing to pay, the terms in which that price is being paid. So the forms of consideration, vendor financing terms with the term amortization, contingencies around the vendor financing piece, and what is exactly being purchased, the amount of the deposit and conditions around that deposit, confidentiality parameters, an indication of whether the negotiations are to be for exclusive for a period of time. Again, this is, as a purchaser, you really want to make sure that you are entering into exclusivity during this next period, and that's what they're agreeing to. They're not going to shop the business while you're in this stage. And then a statement around it being non-binding. You really want to make sure that you are entering into the non-binding contract, and that you can get your deposit back around those conditions that are set forth as well. So there are other things that go into the letter of intent. There are things that don't go into the letter of intent. And that's where we're going to open it up for discussion now. So I'm going to stop sharing my screen here. and we can kind of get the ball rolling. And we run these roundtables fairly informally. We welcome comments and discussion. We welcome debate if people don't agree or do agree on certain things. And we welcome your stories to share. If you've had an experience with a letter of intent or even with different professionals in the industry, we welcome those stories. So with that, I'll, hi Zafar.
Hi.
I kind of threw you into the fire there.
Oh, that's
Any
okay.
additional comments?
No, I think everything like you laid out makes sense, and I think if the point is to kind of provide comments and feedback to people who have questions and what's on their mind and what they're trying to navigate through. So yeah, happy to address anything we can and provide advice that could be helpful.
Thanks. I see, I can see the chat here a little bit here, Giselle, but I see Sheldon has a question. What is light evaluation? So obviously before you have an LOI accepted, you don't have access to all of the information that you would need to do in your full due diligence. So your light evaluation was just my term in, evaluating the company based on everything that you do have access to, everything in public domain, everything that you can find online of the business. And that's when you can also do more research on the industry, market analysis of the industry, referencing IBIS reports for that industry. If a lot of folks that we work with are agnostic. So, if it's an industry that's relatively new to you, then evaluating the industry as well as this specific opportunity that you're looking at. Josh's question. What is the typical timeline for an LOI from signing through diligence to closing? Zafar, how would you answer that question? What is the typical timeline from signing through to closing?
I would say a lot of it is industry specific. So what's typical for, a smaller, one spot location, depending on kind of the nature of the industry. Let's say it's a tech company or something like that. A lot more streamlined than if you're buying, a company that has, let's say forestry or lumber or something like that, industry where there's a lot of inventory, potentially regulatory. You have to think about, is there regulatory components to the industry? Because there's going to be more due diligence involved in that, different kinds of licenses and permits to operate. If it's a very contract heavy industry, property management company or something like that, you'd have to kind of go through and make sure that all the contracts make sense for you, make sure that all the contracts can transfer over. And then part of due diligence isn't just looking under the hood on their side. Typically the LOI will also contain, in addition to the due diligence condition, a financing condition. So how you're going to fund the deal on the acquisition side may impact, the term you need the LOI to be. So I would say a typical LOI, typically runs from 45 to 60 days. That's the due diligence period. Give you time to look under the hood, contact your legal counsel, have them run independent searches to make sure there's, no litigation or any workers' comp claims or bank act or encumbrances on the assets, what all that looks like, PPSA, looking at all that stuff, the land titles office, doing that kind of the standard due diligence searches that any legal counsel would run, to assist you with understanding the business and potential risk areas so that they can then appropriately be covered off in a definitive agreement. You move past that stage, you're comfortable, you waive the conditions. From there to close, probably, another month or so. So I would say any, streamlined transaction is probably 2 months. Outside date, typical deal, 3 to 4 months. And then if it's kind of more complicated than that, then we're looking at something 6 month to a year range. So I know there's a lot of timelines I threw out there, but again, it's specific to the industry you're looking at, how you're funding the deal, and all the factors at play. Sometimes, you get hung up on a specific issue like employees and, which ones are going to transfer over and which ones aren't. And for the ones that aren't going to transfer over, some things that people don't often consider that I think is important is severance obligations. That's something that, if you're onboarding the entire staff, but you might not need them, or you might, only have, only use a couple of, or some of them for a period of time, but they've been around in the business for, 10 years or 12 years, there's significant severance obligations that accrue there that the seller is going to have had the benefit of their service for, but you let them go, you're going to have to pay and recognize all that past service, even though you may have only had them, with you for a few months. So, considering things like that and negotiating those things sometimes takes time. So, considering that and articulating that in the LOI is important, so that you don't get past that stage and then you're in the definitive agreement stage and deal's unconditional. You may have paid a deposit that is or isn't refundable, and now you have these material issues that you have to all of a sudden navigate and negotiate. So, yeah, thinking about that stuff and the impact that could have on the ultimate purchase price you're willing to pay is an important fact.
Thanks,
I wouldn't
Zafar.
rush through the LOI stage just because it's, in most cases, a non-binding document, I guess, is my final point of that. Sorry, Liz.
No, that's okay. Thank you. And we're hearing like the financing piece can also be a component of that timeline in due diligence. What we're hearing from the banks is, like, at best, if everything for them is provided all at the same time and they have everything they need to do their due diligence, they're saying, and Zafar, wondering if you're hearing similar things, that it's about 45 to 60 days at best, once they have everything that they need. And oftentimes they're asking for the definitive purchase agreement sometimes. So that's where they want to see those pieces, and have everything collected ready for their piece. I'll come back to Sheldon's question. He said, so coming back to light evaluation is the evaluation of the company before the letter of intent. He says, he's questioning, is that not accurate? It's not that it's not accurate, but you may not have all of the access to all of the information to do your confirmatory due diligence. So after the LOI, that's when you are confirming that everything that was provided to you is accurate and is what it has, as it has been stated. So they provide you typically enough information for you to understand what you'd be willing to pay on the business. And then after the letter of intent is when you're verifying that all of that is as it is to be true. Would you have anything else to add there, Zafar?
No, I think that makes sense.
Does that answer your question, Sheldon? Scrolling down the chat here.
Oh, I'm good, thank you. The only thing no. So do we have a opportunity to change the price if the detailed evaluation is different with the light evaluation? I mean, once we do the due diligence, we find something else is not as we expected. So can we change the price? Could it be higher or could it be lower? Is that okay? Even we have already signed the offer or makes the offer.
Yeah, I would, I think it's becoming more and more common practice to put a range in an LOI of what you're willing to pay, or put an amount, but with the caveat that it's subject to adjustments upon completion of due diligence and anything else that comes out of kind of when you're looking under the hood, so to speak. So as long as you build in some sort of language to provide that flexibility into the LOI, and it's not just this is the price and define that as the purchase price, you can definitely adjust up and down. And typically there will be some adjustments, for whether it's working capital and target working capital, etc. But in addition, if you find something subject to due diligence and you think that'll impact the purchase price or should impact the purchase price, then you want to leave that room for yourself.
All right, thank you.
Mm-hmm. I think we're looking at an LOI right now, and in a lot of the language is very vague around the adjustments, and sometimes going back to them, if you can squeeze it under the caveat that this is an adjustment based on these findings, instead of, we're offering a lower price, a lower purchase price, we're not willing to pay X because of Y. But sometimes it's all conversational. It's how you present your findings in order for them to understand that it makes sense to reduce the purchase price or adjust it later on. Giselle, I'll leave it to you to know what came next.
Yeah, so the next question is a deposit common practice at LOI, and how much should this be? From Reza.
I would say whether or not it's common practice is depending on whether you're the buyer or the seller. So obviously, but it is becoming something that is negotiated more often than not on LOIs. I would say a common or a decent kind of middle ground would be, you know, something in the 10% range. You know, you could stagger it though, 5% at signing of the LOI, 5% on waiver of the conditions. And you could also set it up such that, you know, it's refundable up until you waive conditions. So typically, if you're the buyer and you want to different, if there's multiple buyers in the queue when a seller's considering multiple LOIs, it's a good way to differentiate yourself from another LOI by adding in the deposit, because most buyers won't start with that in their initial LOI. They're just going to say, this is what I'm going to pay. You know, I've seen strategically now, you know, if you're giving a range for a purchase price, going up as high as, you know, whatever the asking price is, or even a little bit over, leaving the flexibility of the due diligence condition to be able to drop that down and adjustments later on after you've completed your DD. But definitely, yeah, if you're going to do a deposit, 2-stage, you know, 5 and 5 or 10 and 10 or whatever it is, and refundable, and then give them something when you sign the LOI that incentivizes them to sign the LOI. And remember, when you guys get that signed LOI, now they're exclusive with you. So you've eliminated the competition. They're only dealing with you, and there's more opportunity once you've, you know, singled down the conversation just between the two of you. They get deeper into it too. So now they're going to spend time doing due diligence with you, opening up their books to you, showing their business to you, all of that stuff. It's going to be harder for them to walk away if you come back and say, you know what, we did our due diligence. Maybe the bank did an appraisal on the business. They only think it's worth this much. We're going to have to adjust the purchase price by a little bit more. It's really hard for them to walk away from that 40 days in or 30 days in after having invested all that time exclusively with you, saying no to all these other prospective buyers who've probably moved on by then. You know, and then you're able to kind of squeeze a little bit more out of there from a, you know, purchase price perspective, while also making sure that, you know, they were only dealing with you for that period of time. So strategically makes sense to kind of incentivize them that way with the deposit. So you can, although it's not necessarily something buyers like doing, you can use that to your advantage if you leverage them.
Great. Thanks, Zachary.
Next question from Reza as well. How do you broach the asset for share sale conversation with sellers? They get tax benefits from share sales. Are there any benefits for the seller we can point to for an asset sale?
Yeah, so typically the asset sale is a preferred approach for buyers, and share transaction is a preferred approach for sellers. Not only because of the tax benefit that sellers get, but also on the sale of shares, but also because when you sell assets, all you're selling is the assets. When you sell shares, everything that's tied to the business, assets and liabilities, move with those shares. So from a seller's perspective, you know that at that point you've walked away from everything free and clear, and the buyer is assuming the assets plus whatever liabilities come with that, which again magnifies the importance of due diligence and using legal counsel to look at all the other legal risks that you may not consider while you're looking at all the business risks, you know, financial statements and working capital, etc. So that's one thing. The other thing, you know, to address the point directly, you know, is there something you can point to that's beneficial for the seller on the asset sale? Typically not, because it's a buyer-friendly approach to an M&A transaction. I think the way to leverage that is to highlight that you're aware of the tax benefits that they're getting and work that into the purchase price and account for that. So if you're buying the shares, if that's what they want to do, work it out so that you're getting a benefit in terms of how much you're paying. Because in addition to them getting the tax benefit, you also can say that, you know, you're assuming the liabilities when you do a share sale. So there needs to be some accounting done for that as well.
Mm-hmm. Yeah, and that can be one conversation, kind of like you implied. I forget whose question that was, but yeah, bringing those kind of ammunition points as to, well, how, because it's a share sale, why it makes sense that you would be paying a little bit less. And sometimes, to have your accountant crunch the numbers on those things, or to propose that their accountant crunch the numbers on those things to give you more reasoning to back your defense. There was another one there, Giselle.
Yeah, sorry. Bank timeline is also contingent on a QOE as well, depending on the size of business, just flagging for timeline.
Yeah, thanks, Reza. That's a good note. Your quality of earnings. So the banks will want to see the quality of earnings, and so that may extend the timeline a little bit. How have people, I'll pose a question back to the group. How have people, when you're working with, let's say, a business broker, an M&A firm, and they have weighted in on the closing date, how has that been? Like, are they positioning the proposed closing date? I know some of you have had offer letters out there. Are you proposing the closing date? Is there pushback around how quickly they want you to close? Anybody have an experience there? Rez, I see you're off mute.
Yeah, I mean, the last process I went to, the broker asked for a specific date and how long, so they posed it on us. So at that point, I had put in 90 days in that, and it was a negotiating point that they were using across offers to compare.
Oh, so they were hoping that people would be able to close faster than that?
They were ultimately taking it back to the seller, saying, okay, this guy, how much do you like this guy? He's ready to go 90 days. How much do you like this guy? He'll do it in 45 days. And, if you really like the guy who did it in 90 days, like for me, he came back and they didn't really push. I think everybody was at the 90 days for me, so I didn't have that much push. But I've had another process where he said, do you think you can do it faster? Somebody else is willing to go a little bit faster. And I said, okay, sure.
Yeah. Interesting tactic, knowing that you can always push it back or adjust the closing date if something came up in due diligence. Josh, I saw you took yourself off mute. Thanks, Reza.
Yeah, and I certainly went through the process just recently where it was an accelerated timeline. I think I found it discomforting, but it was pushed to 45 days because it was a popular listing that had recently went through a diligence process, and the buyer didn't want to go with the seller, or the seller didn't want to go with the buyer, sorry. So the offer came back to myself, and so it was sort of a leverage tactic, I would say. It's like, well, you kind of have to be within this time frame, and so in order to get the extended financials, I had to submit an offer through the LOI process, which didn't end up going through, but or I ended up canceling it, I should say, at the end. But yeah, it was a pretty quick timeline, so I found that pretty common.
Yeah, Jeff, I see you nodding. You're nodding.
Yeah, I mean, I've had some similar experiences, and a recent LOI, I actually just left the process because the timeline was like way too aggressive. So sometimes you can call their bluff on that and say, like, if you want me to move that fast, then I'm probably not the right buyer, right? So, or it's also a precursor to potentially the business being a falling knife. So you need to be careful about that.
Mm-hmm. Yeah, I like how you positioned it with fit. Like, if this is your timeline, then I may not be the right buyer for you. And we'd hope that they're looking at fit more than price, but depending on what their mindset is, can change.
How if, let's say, you really wanted this business, and go back to Jeff's case where they posed a really aggressive timeline, what if you said, okay, I'll work with your timeline, let's do it, let's do 45 days, but I have all these conditions, I have financing, I have diligence and everything. By the time, as you get closer, hey, financing hasn't come through, I don't have visibility on when that's coming through, it's going to take a couple extra weeks. I mean, they're already down the process with you at that point. I guess, what's the concern there from just kind of extending that timeline? Is that just bad practice? Or I know obviously they can go out and shop it again because you're out of exclusivity maybe, but what's the real downside there?
Zafar, how common is it to see those timelines extended?
Extremely common. I would say, again, when you're drafting the term for the LOI, you don't have, nothing's forcing you to put a specific date in. So, you can have the due diligence condition and the financing condition in there. And again, give yourself 45 days, add in that flexibility in the language right at the LOI stage, or such other date as the parties may otherwise agree to. They spent 45 days invested with you and sent with everyone else. You're asking for another 10. They're not going to leave. It wouldn't make sense for them to restart that process with someone else if you're asking for another 10 days. So as long as you have that language in there and it's extendable, it'll be okay. I think, again, when people talk about LOIs, often you feel like, you need to have a fixed term in it. You don't. You can just say it terminates upon execution of a definitive agreement. It terminates upon the parties mutually agreeing to terminate the LOI. You don't have to have this drop dead date that now everyone's working towards. So, give yourself the flexibility, recognizing that things like financing always take longer than the bank tells you it will. Inevitably, those processes are long. Due diligence takes a while. So use the LOI to maximize your flexibility. I think there's another question here about, do you have to specifically request exclusivity in the LOI? Yes, you do. Remember, as a starting point, that LOIs generally are non-binding. So if you don't tie them into the exclusivity and have a section in there that, all LOIs should have a binding provision section where you tie in certain parts of an LOI and make them binding. Those things being confidentiality, and things like who's responsible for legal fees. So if you walk away, they're not coming after you for, the legal fees they spent on negotiating the LOI, the NDA, whatever else. And tying in exclusivity, making that a binding provision so that they know they are not, allowed to then continue to shop the deal. Or if they do shop the deal, they come back to you and you get a right of first refusal or a right of first offer. So you can match that deal before they're able to kind of even explain. So definitely ask for exclusivity, definitely include a binding provisions section and list out, certain sections of the LOI and make those provisions binding. But yes, unless you ask for it, the starting point for LOIs is that they're not.
Yeah, that's careful. Like if someone else is writing the LOI, like we saw just recently where the seller wrote the LOI and then presented it to the purchaser, and they were doing this for all the purchasers. So, in the case where you're not writing it, or if something gets presented to you and it is something that, okay, this is easy, I'm just going to use their version of the LOI and make sure that it's inclusive of everything that you want it to be and it's not omitting anything. And that was a question that I had for you, Zafar, is what is the and maybe there's lots of things, but what is the most common thing that you see forgotten in an LOI that people are overlooking?
Exclusivity, definitely one of them. I wouldn't say necessarily provisions that are forgotten, but forgotten are the parts where you have areas where you can build in flexibility. To the timelines, to the condition periods, to the price, all these things that we've kind of talked about so far. You don't have to make an LOI so airtight. That's what the definitive agreement is for. One thing that I would say is forgotten commonly, or is a common forgotten point, is competition, non-competition, or transitional services. If you want the seller to stay on for a period of time and perform specific tasks, build in a transitional services period into the LOI, so that when you get to the definitive agreement, that's not a new negotiating point. They know you want them to stay on for a period of time. They know what that's going to look like. That's part of the deal, so they can consider it from the beginning. Non-competition is an important one because, and make sure you tie it, the commencement of the non-competition period, to the end of the transitional services period. If you tie it to the beginning, you tie it to the closing date, then they work with you for 2 years, and that's the term that your non-competition period is for. Well, you already had them locked up. So now the non-competition period ended the minute their transitional services period ended as well, and they can come back into the market and compete with you. So make sure that you stagger transitional services period for a year or two, leave flexibility in there for you to be able to terminate earlier if you don't need them around anymore. Why are you paying them? Also, some sellers just really have a hard time letting go. So if they're stepping on your toes and not letting you do the things you want to do once you take over the business, you want to have the flexibility to let them go so they're not tied in for 2 years, and you're kind of handcuffed in that sense. And then tie the non-competition period to the termination of the transitional services period. So that kicks in once they're no longer with you, giving yourself, effectively 3, 4, 5 years of runway on the non-competition without really saying it that way. And make sure those two things are in your LOI, because you guys, if the parties just sign the LOI without the non-competition, seen it a million times where the seller's lawyer will say, well, you didn't bargain for the non-competition, so if you want non-competition, you got to bargain for it now. Let's talk about how that changes the purchase price. And the way it's treated in tax as a restrictive covenant in the Income Tax Act, you have to pay separate consideration for that if it wasn't already built into the deal. So that makes it really complicated to just say, no, I always intended that, like throw it in. No, not going to work. You're ultimately going to have to pay more to get that non-competition covenant. So don't, put it into the LOI. They agree to it. If ultimately you decide this guy's going to retire anyways, I don't need it. Okay, you don't need to have it in the definitive agreement if you don't want to, just because it's in the LOI. Remember, LOI is not binding, but give yourself the flexibility and scale back versus trying to build it in as a new deal term and introduce it later. Sometimes buyers take the approach of like, yeah, I want non-competition, but I don't want to tell them about it now. I'll wait till we waive conditions and we're at the definitive agreement, and I'll bring this point up then, and we'll deal with it then when we've gone this far down the path. Don't make that mistake.
Yeah, and I'll add to that too, is like if the seller's retiring and you may not feel like they're at risk of re-entering the market, be conscious that they may be approached to consult in the industry, and they may not be directly competing, but they may be consulting with another competitor of yours in the market just because of their network, and for that to be tied into the non-competition as well.
Yeah, and also financing, like funding, because you're buying them out now. All of a sudden they're flush with cash, they can go finance a competitor. You don't want that either. So tie in non-competition standard provision will include all those clauses. You can't go fund a competitor, you can't go consult with a competitor, all that stuff. So yeah, you make sure you cover off all your bases, because there's lots of ways that a seller could compete with you without actually just hanging up their shingle right next to it.
Mm-hmm. Yeah, great comment. I think my biggest takeaway was that non-compete after the transitional period. That was a new one for me. I'll take that one. Reza's asking, is it common practice to have your lawyer review your LOI before submitting it, or for them to actually draft it?
Yeah, bias aside, I strongly recommend it for your benefit. I'm sure you've heard a few things in this discussion that you might not have thought of before. There's probably plenty more when you actually look into the deal and are at that point. So use the lawyer as a resource. If you have a template form of LOI that you're comfortable working with and you want to reduce some of the legal spend, put some of that together. But I think the cleanest, most efficient path is call your lawyer, give them the deal terms, have them put a draft together. And in that draft, you'll probably see a bunch of notes to draft for you to consider, because things that you might not have thought about before, and ultimately what you eventually end up preparing and providing and putting forward to the seller as your offer will look a lot different than what you would have ultimately sent had you not used your legal counsel.
Yeah, we hear some horror stories of people having to pay higher legal fees to fix things, or you spend longer in negotiations doing the definitive agreement if a lawyer hasn't reviewed, even at a minimum, just reviewed your version of the LOI.
An LOI is not going to be a costly expense, right? Invest a couple grand or whatever it is to save you, tens of thousands of dollars in time and cost, when you do the deal, and now you got to figure out how to navigate through it, or you thought you were getting all these contracts, but you never got consent to move them over into your name, and all these vendors are now walking away, and you don't really have what you thought you paid for. So all that stuff, make sure you take the time to consider, which your lawyer can definitely help with. It's worth spending the extra 1,000, 2,000. And I know I get it from a buyer's perspective because you don't know if the LOI is going to get accepted. You spent money on an LOI with the lawyer, never got accepted. Now you look at it as a sunk cost. You got to do it again because you look for the next business. And sometimes it takes 2-3 kicks at the can with an LOI before one's ultimately accepted. But I guess know what your downside risk is if you're not going to use counsel. Ultimately, it's a business decision.
Thanks, Zafar. Giselle, we had some other questions there. Shane, I know you joined us late. Welcome. If you've got any stories, I know you closed deals. I think you've got 2 in the bag right now. So if you've got any shared stories you'd like to enlighten us, feel free to pipe up. But
yeah, nothing really. I mean, I caught the bit about the tight timeline. I know that I've experienced that too. I always I think Jeffrey said it well. You just communicate to the sellers my reasonable timeline. I guess the most recent story to share is when they do want tight timelines. We've written LOIs and those LOIs were not accepted because of the tight timelines. And it's just, I think it's reasonable to communicate to the sellers that there's a commercial timeline that is just, it's reasonable when it comes to a commercial timeline for the banks or a commercial timeline for the lawyers to have to get through that. It takes time, and we've lost opportunities as a result of just telling them a reasonable timeline. But it's just fair. They're not, Jeffrey said it, it's not our company then. It's not a fit for us, right? So if they can't be reasonable in those assumptions, then sorry, it's funny because we'll follow up with them later on and ask them, how's it going? And they say, well, it's still tied up. Even though they said we could do it in 90 days. And we said, we can't do that. It takes us 5 months.
Almost
right?
always, Shane, almost always.
Yeah, almost always.
always.
Right? So yeah, and so it's just unfortunate, but that just means that they're not the right company for us.
yeah, or unfortunate for them because they may be ill-advised on the timeline, and they maybe being told like, okay, push them on the timeline, when really, if you were the better fit, then they were seeing time and other deal terms in place of, who's the better fit to buy it and take this company into the future, and getting tied up on that little factor. It's unfortunate for them on their side.
Yeah,
So
the
true.
psychological anchors that get advised to people about what those expectations are. I'm sure lots of people on the line here have lots more stories to share about that, but I think it's usually unfair of someone to ill-advise somebody, whether it's their accountant or the lawyers or a broker, and just set a reasonable timeline. It can be you can bookend it to a minimum and maximum, but make it reasonable so that it can be a fair process. So.
Yep, so true. Thanks for that, Shane. Nice to see you. Shane's
Yeah, you
based
too.
in Alberta.
Hi, everybody.
Yeah, you're focused on egg related companies, correct?
Yeah, for the most, I'd say 80% of what we try to do is in the agriculture vertical, whether it's from the farm gate to beyond the fork. But the other 20% that we're trying to open up our aperture into is more personal interest stuff or essential service type businesses. So.
Welcome. Thanks for tuning in.
Thanks.
I see another question here. Are M&A vendors, lawyers, due diligence consultants, banks open to success-based fees or attributed to the company post-close? So I take this, Reza, as buy-side advisors being paid on contingency. Is that your question? Yeah. Yeah, I recently ran into another purchaser who is trying to find advisors who are happy to be paid on contingency. What's your thoughts on that, Zafar? Is that something that you get asked?
Not typically, no. But at least not for these types of transactions. I think more on sometimes more on the sales side. Usually we get asked on that stuff when you're helping the company raise capital, but not in the context of M&A, at least not typically.
Yeah, I haven't seen lawyers or accountants in Canada do it. I know it is a conversation in some circles. M&A, like transaction advisors, advisory services, will typically do a hybrid on the buy side. If they're involved in search, like Village Wealth has some services to that degree as well. In search, or if raising capital, often professionals who help you raise capital will be hybrid on a contingency fee, and take a percentage of what they raise for you. But the lawyers and the accountants and the banks, I haven't, in my experience, I haven't seen them do that. Does anybody else have any experience of professionals working on that fee structure? Jeff, have you seen it?
Yeah. I know a few that they'll roll the deal fees until you find something. For maybe a year and a half, whatever. Especially if you're like doing a formal search vehicle, then they might say like, look, there's you're gonna win some and you're gonna lose some. We'll give you the advice and then we'll just roll that into the ultimate arrangement at the very end when you transact. And I'm a big fan of that structure because I think it's a vested interest on both parties, and you care less when you get a deal done later on if you're rolling over previous failures, right?
We just have some background noise there. Oh, it's gone now. Thanks, Jeff. What professions do you hear of them doing that? Is that on the advisory?
Legal, not advisory.
Sorry, legal?
Legal, yeah.
And would they more be like small independent firms?
No, some really big ones will do that.
Interesting. Yeah, interesting. No,
I've seen that similarly on the accounting side to some degree, where they will help you kind of set up NewCo, the structure, and kind of build that to post close. Because I mean, you're kind of involving them kind of later stage when you typically post LOI anyways. So they're assuming you're going to get to close, and so they can, and then for them the benefit is that hopefully they're going to take the bookkeeping or whatever accounting services on the other side. So I've seen the accounting side be a little bit more willing to at least even just bill the company afterwards as well, so you can just start expensing it.
That's true. I have seen that in some cases. Yeah.
There was a question in the chat. Is it common to include language around the vendor filing a tax return within a certain period of time post change of control?
Can you read that one more time?
Is it common to include language around the vendor filing a tax return within a certain period of time post change of control?
Zafar, what would you say to that?
Yeah, I mean, I wouldn't say it's common or uncommon. You certainly can if it's a consideration or a concern for you. I think typically that's something that gets put into a definitive agreement anyways, and lawyers understand that, and it's not something that you necessarily need to negotiate about. So, because there's timelines in the Income Tax Act that require, the CRA kind of drives the timelines around that anyways. So, if you think that, hey, I don't know if these guys will actually do it, then put it into the LOI. I would say make sure it's in the definitive agreement as a covenant and a deliverable at closing. So you already know that it's covered off when all the other closing paper gets signed. This can easily be a fund that gets circulated as part of that. Sign that, and then it's already ready to go. And then whoever, buy side, sell side, whoever's responsible for filing makes that filing within a certain period of time. You're covered off.
Perfect. Thanks for that. We do stretch these to an hour and a half. I'd welcome your feedback if everybody has a preference for if they'd like to keep these sessions to an hour or an hour and a half. I know the reason we put it to an hour and a half was because we ran late one day, and the conversation was really strong. So we ended up cutting it off. But if anybody wants to comment in the chat there what their preference is for an hour to an hour and a half, because I know we do lose people a little bit when we go over an hour. But we've set it for an hour and a half today, so we'll keep going here. We do have questions. Zafar, I understand if you only had the hour. Understand if you need to drop off. We are at that hour here, but we can stay on as Village Wealth and continue if you need to leave. How are you for time?
I think so far okay, but if that changes, I'll let you know. But I'll stay on as long as I can.
Okay, wonderful. Well, Giselle, do you want to pose another question there, and then we'll just keep going with. I know Giselle has a handful there, and then we've got Zafar at our disposal here, guys. So poke away at questions, keep throwing them in the chat. This is great so far.
Yeah, just looking at some of the questions here, I guess, what is often, well, Liz already kind of asked what was forgotten, or when should I start to involve my lawyer?
Probably, I mean, again, I think as soon as possible. Like, I think the starting point is, I appreciate the cost consideration and the concern around that, and wanting to handle as much of the process as you can, or you feel comfortable with, before you bring in legal counsel. I think the bigger if you're hesitant in talking to and involving the legal counsel at an early stage, I think the fundamental question is, do you have the right legal counsel? Because if your lawyer is a true partner to you, then they should be willing to assist you. They should be fine putting in the time, having the conversations with you, addressing your questions, helping you through those kind of anxious moments that you have, because it's a big deal. All of these things are big deals. A lot of money at play. We understand all that. Find the right legal counsel that is willing to make time for you, have conversations with you, provide you with the guidance and the support that you need, because that's really their job, to cover off your risks. You take this risk that you could have easily mitigated if you had a conversation with your lawyer ahead of time, but you didn't call them because you didn't want the clock to start. To me, that's a sign that you just don't have a lawyer. Talk to the lawyers that are willing to work with you, be a partner to you, and help you get to the stage where you do the deal, because the lawyers that are willing to do that recognize that, hey, it's in their benefit for you to actually use the money and buy a business, because then they can be a counsel to that business. So people will be willing to invest that time. I definitely am one of those individuals, and I know there's a lot of people like me out here. So out there, so find the right lawyer, and involve them from the beginning, because I think that's what they're there for, and B, that's the best way to make sure that you're avoiding, the big traps that people fall into, and then ultimately have to go talk to a lawyer to get their help to dig themselves out. So.
I like how you said, your lawyer is a partner, and if they are partnering with you, they will be invested. And it's, like any profession too, it's finding the advisors who are relational and not just transactional. And when doing deals, you want to find the lawyer that has done enough deals that they know this world and they know the cards to play as well. Like, just make sure you're not using someone who does, commercial real estate, consistently, and they do transactions as well. Making sure that they've got the right experience behind them is so important. Reza says here, Zafar, for a bigger deal, I'd love to work with one of the big legal like Owlings. For a tiny acquisition, that path isn't as clear on size of vendor to work with. What's your opinion there on smaller micro deals? I know, I think the first deal that you and I worked on was like 400,000. It was micro, and that was 5 years ago.
Yeah, I don't think that. I mean, I know for some firms, deal size is a threshold point, and a gating item whether or not they'll take on the file. I know Gowlings is so. We've done deals for 250K, really small deals where one shareholder is buying on another shareholder for 60K. It doesn't matter. The deal size shouldn't dictate the size of the firm you work with. It's more important to make sure that you're working with someone who is a trusted advisor, and someone you can rely on. So find that person, big firm, small firm, that doesn't matter. Find the person that you have a good relationship with, and use that person. And I know for myself, we've done deals from, like I said, 60K, sometimes less, to into the millions and billions. So shouldn't be the size of the deal shouldn't dictate the size of the loan or law firm.
Mhm. Yeah. And the more prepared you are, you can kind of manage some of your fees, the more prepared you are as well. Like I've closed deals personally for myself with very, very little legal overhead, just because I found the right lawyer to work with, and they advocated for me, and they knew I was on a budget. They worked with me. So
I will say, like, we do fixed fee deal arrangements all the time, so you get the cost of need. Firms of our size, okay, yes, we're a big firm, our billable hour rates are potentially higher than the smaller firms, but with that comes a bunch of efficiencies and expertise and bench strength in terms of being able to use and leverage junior lawyers to do a lot of this work. So there is a path for firms of our size to deliver legal services at a cost-effective manner. So it's a matter of, again, finding the right lawyer that's willing to do that and understands that and able to deliver what you need for the price point that makes sense.
I think that goes to say about any profession as well, too. Like, that's one thing that we've been hearing a lot with the banks, is it's not necessarily the bank that may or may not be willing to do the deal or be a good partner in the deal. It's the banker that you've found to work with. And sometimes it takes time to find the right professional to work with within a big firm, but they do exist. They are there. There's every firm has people who are heart-centered and relationship-based. It's just a matter of finding them. I know Jeff's nodding, and Jeff's been building his network in Toronto very strongly. So I mean, he's piggybacking on other people's recommendations for these relationships as well, and continuing to grow your network and get out there and continue to meet other people who are buying businesses, because there's so much we can learn from each other. Got another one here from Josh. Zafar, what if you were requested to sign a PSA that has non-binding verbiage?
It's a little bit odd.
Do you mean binding verbiage, Josh?
No, non-binding. So I've gone through the process once where the brokers between the seller and myself, because they wanted to expedite the deal, requested that I signed a PSA, but it was non-binding. The idea being, once you remove all of the conditions, everything's basically in place outside of I guess that final signature.
Yeah, I mean, I've seen that happen. I think it's a little bit odd. Obviously, I think the starting point, again, Josh, that I would take with that is LOIs, and by inherently being a non-binding agreement, and the purchase agreement inherently being a binding agreement, those have been interpreted specifically. They are what they are because of how the courts have interpreted. So trying to sort of like skip the LOI stage and move straight to the purchase agreement stage. The reason you do the LOI is because once you start doing the due diligence, there'll be things that you uncover that you need to cover off in the purchase agreement. If you sign the purchase agreement with reps and warranties of what you think the business looks like, and then you uncover a whole bunch of stuff, but the only change you can make to this non-binding thing is that the non-binding piece falls out and the conditions are waived, you're not building an agreement that is fit for purpose, because you're signing it, before, it's like buying the car before taking it for a test drive, like things like, and then people do that, but not necessarily something I would recommend. So, and they're interpreted differently by court. So if you ultimately now want to come back out of this deal, and you end up in litigation over it, courts are going to interpret that as saying, okay, yeah, it's odd to, first of all, the concept of a non-binding agreement is, a purchase agreement is weird. So, you may not get the result you want, and now you're stuck in a situation you don't want to be stuck in. So, again, one of those, like, spend the extra $1,000 or $2,000, get the LOI, give yourself the time, go through the due diligence period, make sure everything's good before you ink the agreement. So, I'm not surprised that that's a path that people are using, and I've seen it being used to try to skip the step. But the typical path is the typical path for a reason. So it makes sense in the context of M&A to follow that, NDA, LOI, ultimately purchase agreement, and everything else that comes along with closing. So yeah, to the extent that you can follow that and kind of steer the broker in that direction, I think you're better suited.
Great, thanks.
Yeah. Good question, Josh. Yeah, that doesn't come up very often, but yeah, when it does, it's like, ooh, you didn't know best practices, it would definitely throw you for a loop.
Yeah, and sometimes red flags, right? Like, why?
Yeah, that's what I'm thinking.
What are
Like,
they
yeah.
thinking? What does the seller not want you to know before you sign the agreement?
Yeah.
And then,
What's the rush here?
Yeah, what's the rush?
Yeah, definitely red flags there. Rez is asking, can you confirm we need to work with a lawyer in the province, within your province, and better in your specific city? How does geography play?
Reza, do you mean like in terms of the province or the city where the target is or where the buyer is? Is that the question?
So I guess open question to you then. I'm in so I'm in Toronto. Let's just say maybe two examples, one target in Toronto or the other one in BC or Calgary, let's say, and how would you go from there?
Again, I think like the laws are very similar, and in M&A, I think you can use whoever makes sense for you. I don't think you have to use a lawyer. You know, if it's a buyer and a seller in Toronto and your lawyer's in Calgary, I mean, we do deals like that all the time. So I think, again, find the right person that makes sense for you. And obviously for Toronto deals, using someone out west, significantly beneficial in terms of, you know, what the cost would be because the rates are cheaper out here. So I wouldn't necessarily say you're stuck to that. And we do deals where we're on for a buyer, you know, in the States and the sellers in Canada. So, you know, you can act cross-border. There's no reason why you can't act through the provincial boundaries. So yeah, I don't think that needs to be a hurdle.
Okay, that's interesting. So then would it just change, Zafar, when the agreements are tied, it always, you know, how it states, you know, pertaining to the laws of, and then would it be the province, would the agreement state the province in which the target was located, or?
That's, I mean, that one is always, that one is always a negotiated item when buyer and seller are in different jurisdictions. And the whole reason why that's argued is because if something goes wrong, you want, you know, the laws of your area to apply, or you want the action to be adjudicated in your place so you don't have to travel for litigation and all that other stuff. So, you know, that's why a lot of that stuff is argued. I would say typically the governing law should be where the business and the assets of the business are. Sometimes it's not just in one jurisdiction. So, you know, again, it becomes a negotiated point. But, you know, I've done lots of deals where the governing law was Ontario, the buyer was from BC, and obviously I'm based in Calgary. And to address Sheldon's question about the lawyer in BC saying that she couldn't work on projects in Ontario. So that's a situation of where you're called to practice law. And the reason we're able to do that differently is because we're a national firm. So we'll look at it and we'll be able to do the advising, have one of our lawyers in the jurisdiction that the transaction is taking place in, review it, or we have precedents that already cover off the legal differences between jurisdictions. So, you know, in those situations, we're not bound by the same restrictions.
Perfect. No, that makes a lot of sense. Thanks for that, Zafar. We're losing a few people here. Basil, nice to see you. I didn't see your name earlier. What else have we got, Giselle? Oh, one other question, Zafar. What's the difference between and Jeff, I welcome your comments on this too. The difference of the use between an expression of interest and a letter of intent. Yeah.
Jeff, you want to take a crack at that first?
Sure. I mean, anecdotally, like expressions get tossed around a lot more probably than formal LOIs. Obviously, there's a lot more guardrails and parameters around the LOI than an expression, which is usually or sometimes a range, and then an LOI will probably be more inclined to be a specific value that you're diligencing. So it's kind of like you know, an expression is like the first date or whatever, and then like and then the LOI is like something, you know, the 10th date where you're a little bit more serious about the relationship, but you still need to diligence before you get engaged. So
Yeah, I like that. That's a great analogy. I'm glad I deferred to you.
I've never used that. I'm just literally making that
no, I
up.
like
And this
that. We
is
should use
being
that more
recorded,
often,
so
man.
weird one to use.
It works. I think, yeah, the only kind of other thing I'd add to that is expression of interest is, again, like that feeler level where you can't put anything binding in an expression of interest. Whereas a letter of intent, even though it's generally non-binding, we talked about the importance of including certain binding provisions. That type of stuff doesn't make its way into expression of interest. So, you know, things like non-competition, exclusivity, and all that stuff, those things are not in an expression of interest. So I think you probably can, you know, for the earlier point about circumventing the LOI and going straight to the PSA, you can probably circumvent the expression of interest and go straight to the LOI if you use the NDA as that initial sort of expression of interest. You're signing an NDA with someone and it contains enough language in there that it needs to, they know you're interested. Why otherwise are you signing an NDA to have a conversation with them and even take that preliminary look behind the curtain, so to speak? So if there is a document you want to knock out of the process, don't make it the LOI, but make it the expression of interest. You can live with it.
It was interesting recently. We heard that a broker was asking a buyer for an expression of interest, and then as they got to chatting more, they had lined up a meeting with the seller, and the broker had finally gotten on the phone with the buyer, and then the broker said, "Oh yeah, no, don't worry about the expression of interest. We just wanted to make sure you were serious, and you had a willingness to put one together." And this was before ever meeting the seller, and I think they had signed an NDA and they had seen the sim, but they hadn't talked to the broker yet. They were still dealing with the admin team, and it just seemed a little odd that the deal size was like 2 million or something. It seemed odd to me that the broker was asking for an expression of interest at this early of a stage, and then just waived it and said, "Oh, never mind. We just wanted to make sure you were serious." You know, it was his way of weeding people out.
Yeah, and that's usually what it, you know, one of the kind of more baseline purposes it serves is who's going to do that. And one of the other things that I know I've seen brokers use an expression of interest for is to figure out who's willing and isn't willing to sign an NDA. Because a lot of times you'll have people that are not willing to sign an NDA, and that's, you know, if that's not going to be something that's part of your expression of interest, just to kind of take that first look at who the potential buyer group will be, or the buyer, you know, list of buyers will be. You can weed those guys out right away, because, you know, if they're not willing to sign an NDA, then again, red flag. So, and a lot of sellers won't be comfortable having discussions at all without that protection in place. So, another way you could use or purpose an expression of interest.
Yeah, coming back to the NDA conversation, like seeing is like, if they're hard to enforce, are they, I mean, it's a formality, but because, you know, there's pushback that we hear on both sides from buyers and sellers about the NDA. I'm interested to hear everyone's opinions on the value or the headache of signing them.
Yeah, I think it's, yeah, you're right. It's hard to, it's oftentimes difficult to enforce, but it's better to have the document versus not have the document. Oftentimes it's less about the enforceability and more about the comfort level that a seller will have disclosing information to you if you have or have not signed it. A lot of times, again, it's like a threshold point to, you know, even to get through before a seller will even start considering you as a prospective buyer of the business. So I think important to work through that piece.
Yeah,
there shouldn't be a reason not to sign an NDA on the buy side, unless, you know, you're a private equity firm, stuff like that. There's certain areas where, you know, it doesn't make sense and people won't sign. And in those situations, the seller's getting the right legal advice. They'll know when they should waive that requirement. They should.
Shane, what's your opinion coming from private equity, and Jeff too?
Yeah, well, I had a question I wanted to ask on top of that too.
Yeah.
Like, we don't mind them. We would like them to be mutual non-disclosure agreements, because then it's a two-way street. They won't share any information about us, and we won't share any information about them. So we don't mind them. It's just peace of mind and comfort for the sellers. But my question is, how often anybody sees competition clauses in NDAs? Because every now and then, like, I hate signing them blindly. I always have to go through them in great detail. And when you're busy, you just kind of you skim through it really quickly and you brush it off. But I stopped doing that and had to go through in much greater detail, because every now and then I've seen them with competition clauses in it. I really hate that.
Yeah, I really hate that too. It's not the point of an NDA at all, but people definitely are sneaking them in. I don't understand. I mean, I understand from a seller's perspective why they potentially want that, but at that point, that's not. I don't think it's appropriate to ask at that stage. And I've seen companies or prospective buyers sign that, again, probably blindly, because not getting the right legal advice, or it doesn't matter in that situation. But definitely not something that I would advise on the seller side, including it's not the appropriate stage for that.
Yeah.
And you're potentially the outcome there is you're trying to attract a group of buyers to see what you can get for your business. You're gonna potentially have the adverse effect of discouraging a bunch of prospective buyers just by having a clause in an NDA that really doesn't do you the benefit that you think it does. So it actually has the opposite effect of what you want, which is attracting a group of buyers to look at your business.
Cool.
Yeah, I see Yvette's coming in here. Now I'm guessing maybe there was a hi, Yvette.
Hello, joining the
Last few minutes. Yvette is joining us from Texas, I believe.
Yes, from Austin, Texas.
Nice to have you. You'll have to catch the next one. Unfortunately, we're just wrapping up here, but I will make the last call out for any last questions, any last lingering questions. Maybe we'll leave room for two more. We've gone through a lot today. Giselle.
I have one on maybe it's just made a matter of thoughts on the whole idea, but I don't want anybody to sort of lift the kimono and show us what's underneath if they have any competitive or strategic advantages here. But I'm curious as to the groups, how often you see an LOI written where you roll equity from the sellers into the structure. Well, we don't typically do it, but we've recently started contemplating a piece of it. And so I'm just kind of curious as to how often people see that, or if they see it at all, or more now than previously, or if people don't want to share the competitive advantage, that's okay too.
I don't have
usually
any comments
push for it in some capacity. Sometimes it's really beneficial to the deal, but from like a search fund perspective, which is what I'm spending most of my time doing now, that's difficult, because usually the targets are people that are retiring and want to have a path to a full exit. So saying, hey, I know you're 72, do you want to keep owning this for another 10 years? Like, that's an awkward conversation. But situational dependent. I've also come across a lot of deals where there might be another layer of the management team that might want to participate in some capacity and roll over and continue staying on for the next phase of growth. And those are usually like really great outcomes in my experience.
I mean, I'm only one for one so far on my LOI, which had a pretty substantial amount of equity rollover, because that's something that the owner was willing to do. He had taken it to kind of 6 million top line. He knew the business potential was easily double, triple of where he had taken it. And so he was open to that conversation, and actually a pretty substantial amount of, it wasn't just equity roll, it was also vendor financing as part of that as well. So I think it's the stage of the buyer. I mean, this guy had already made some good money, but he was business savvy, still was like, I think early to mid 50s and still had some more legs under him. And he just took a second bite at the apple. So he was enticed to participate.
Yeah, and I would say similar to Jeffrey, I'm usually in that situation. And for employees, what I'll propose is like some kind of pay incentive, but I try to keep the equity clean, because if it had to come up for sale again, it can make the equity structure messy. So if the equity we've given you extra X thousands of dollars, can I just give you extra X thousands of dollars?
Mm-hmm. Yvette, maybe let everyone know what your professional background is, or what perspective you're coming from.
Yeah, okay, thanks. So professional background is I was an ex-corporate strategist at Accenture, and I've done product launches, $2 billion cost reductions, to M&A deals over 2 billion, and smaller than 600 million. And then I started helping smaller businesses, and now I'm pursuing M&A myself, like where I'm the going to be the owner, and I'm doing like 3 in the, most likely it's going to be 3, but in the B2B finance and accounting space specifically.
Thank you. Welcome. Hopefully you'll join us again. Zafar, any other comments on Shane's question there for equity rollover?
I think similar to what Jeff was saying, Shane, I think, yeah, we definitely see that a lot more. People, startups are using, we all know this, but startups have used equity like currency for a long time. So starting to see more and more of that. I think just as a seller, it's important to be mindful of what the eventual exit strategy is there. The point of selling a business is typically to then stay invested and not have a path out, especially if it's a private company. So I think the importance there is what the share terms look like, having ability to potentially put the shares forward under a USA or whatever it is to be able to sell out and exit eventually. Because at that point now you no longer control the business. So less control over what's happening with your invested capital situation, particularly when you lack liquidity in private deal. Buy side, definitely something you can use. I think from a structuring perspective, again, important to, if you want to incentivize the seller to accept that deal instead of an all cash deal, to build in certain mechanics that provide for opportunities for a streamlined exit path, and bake that into share terms and the type of security that you ultimately give to the seller. King, lots of ways, Shane, to get creative about that too, using safes and debentures and stuff like that have an exit based on a particular trigger point, so that then the seller again feels comfortable accepting that. So again, happy to flush that out with you in more detail if you'd like to comment on that often.
Thanks, guys.
Thanks, guys. This has been great. I know we've seen everyone drop off in the last half hour, but thanks for staying till the end. Like I said, moving forward, we're going to be doing two virtual sessions a month, one open, and the webinars will be recorded. The roundtables are more for intimate discussion between our subscribing members, because at that point we know who everyone is, we know their search criteria, and we can have a deeper level of conversation with everyone having a sort of a base level of knowledge. So keep that in mind. Roundtables will be more private conversation, and the webinars are more for us to invite and kind of promote things more broadly. So pick your preference of how you'd like to participate and tune in or come to all. We're really excited to kind of start this virtual event series and roll it out through the rest of the year. We started out doing virtual events when we started Village Wealth and kind of came away from it, and it's time we kind of resurrected it. So we're excited to be doing this again. Thank you, Zafar, so much for joining us. This has been invaluable to everyone, and I think the breadth of conversations and the depth of the questions spoke for itself today. Everyone was very much engaged. Nice to see the variety of people from across the country. And Yvette, you're our first US participant, which will be changing this year as well. So again, very excited to have you all, and hope to see you next month. Oh, and if you have any comments on topics, or you'd like us to bring anyone in specifically, please let us know. And if you're in our Facebook group, you can send us a note there, or you can send Giselle or any of us another note if you've got any topics that you want us to table. All right. Thanks, guys.
Thanks, everyone.
And,
Bye.
see you next time. Thanks, Ever.
Yeah, thanks, Liz. Bye.